Imagine owning a business where the government hands you a monopoly to create money out of thin air, and you get to charge everyone else interest just to use it. This mechanism is called seigniorage, and it sits at the absolute foundation of modern money creation. In the United States, it costs the Federal Reserve less than 15 cents to physically print a $100 bill, which commercial banks then buy for its full face value. That leaves an immediate gross margin of over 99%, a figure that reaches nearly 100% when money is created electronically. Look at a specific example from the Bank of Canada. They issue a $10 bill with an average lifespan of 11 years. Over that entire decade, the total cost to print and distribute that specific note is only about 3 cents a year. This equation illustrates the seigniorage math. When the central bank receives electronic payment from commercial banks for that bill, they reinvest the funds into interest-bearing government bonds. If those bonds generate a simple 2% interest rate, the bank earns 20 cents a year. Subtract the 3-cent operating cost, and they net a clean, highly predictable 17 cents a year on a single note. These steady profits easily cover the institution's operating costs, making the operation look like a safe, lucrative public theater. But that surface-level math hides the actual mechanics of the economy. Central banks do not directly control the broader money supply, and they do not physically print every dollar in circulation. The vast majority of money in a modern economy is actually created by private commercial banks at the exact moment they extend credit and hand out loans. This diagram shows a $100 deposit moving through the system. The commercial bank keeps only a small fraction of your cash on hand, calculated on the assumption that not everyone will ask for their money at the same time, and lends out the rest. This credit-driven system transforms the global money supply into a highly leveraged digital speed network that remains inherently fragile. If private banks are the ones actually creating the money, how does the central bank exercise authority over them? They manage the network indirectly. Private commercial banks are legally required to settle their transactions with each other using electronic reserves held directly at the central bank. If a commercial bank runs short on these reserves overnight, they have to borrow them. By adjusting the policy interest rate on these specific reserves, like the federal funds rate, the central bank establishes the absolute baseline cost of money. That single policy rate acts as the foundational anchor, quietly dictating the pricing of every mortgage, credit card, and business loan in the global economy. But this fractional reserve engine contains a structural vulnerability, known as the asset-liability mismatch. This scale represents maturity transformation. Commercial banks take short-term, highly liquid liabilities, like your checking deposits, which you can withdraw at any second, and use them to fund long-term illiquid assets, like 30-year mortgages or 10-year government bonds. Under normal conditions, this generates a profitable spread. But when a central bank aggressively raises interest rates to combat inflation, bond prices fall. The long-term bonds sitting on a commercial bank's balance sheet suddenly lose massive amounts of value on paper. Look at the 2023 collapse of Silicon Valley Bank to see exactly how this math plays out in the real world. During the tech boom, SVB's deposit surged from $74 billion in 2020 to nearly $200 billion by 2022. To capture yield, they invested those short-term startup deposits into high-duration mortgage-backed securities with over 10 years to maturity. When the Federal Reserve hiked interest rates, the market value of those long-term bonds cratered, leaving SVB holding massive unrealized losses. If depositors remain calm, those paper losses mean nothing. But panicking tech startups began burning through their cash and initiating rapid digital withdrawals. SVB was forced to liquidate $21 billion of its bond portfolio at a devastating $1.8 billion loss just to meet customer demands. That single liquidity crunch triggered a text message speed digital bank run, destroying a perfectly solvent 40-year-old financial institution in 44 hours. The SVB collapse exposed a chilling reality of the modern era. Healthy banks can die simply because they cannot liquidate their long-term assets fast enough to meet a sudden wave of short-term withdrawals. This is where the central bank executes its most critical economic function, stepping in as the lender of last resort. When a panic starts, the central bank uses repo windows and discount rates to inject emergency, overnight electronic liquidity directly into commercial banks. This schematic demonstrates how the central bank intervenes. They aren't handing out free money. The central bank lends these newly created electronic reserves strictly against high-quality collateral, allowing commercial banks to bridge the timing gap without selling their assets at a catastrophic loss. By standing ready to act as a backstop with infinite electronic liquidity, the central bank buys critical time, ensuring a localized squeeze doesn't freeze the entire global credit market. While seigniorage provides a steady income, the primary objective of a central bank involves managing the structural risks inherent in modern finance. They function as the ultimate systemic risk manager, balancing trillions of dollars of maturity and interest rate risk at the center of the financial web. The survival of the global economy relies on the central bank's ability to maintain a precarious equilibrium between absolute public trust and extreme financial leverage.